Welcome out to the Trading Justice Podcast. This is Mark Justice, joined with my brother Matt. We are the Justice Brothers from Tackle Trading, and we're going to talk some rates, robots, and reality checks in what really was one of the more interesting weeks in the market in a long time. It's one of those weeks where you have so many notes that you're like, I don't know if I have enough time in the course of a weekend to go through everything. Matt, just on DeepSeek alone, I got like 8 pages of notes, and and so I'm really looking forward to this podcast. But before we get diving in, before I even ask how you're doing, listen, it's February 1st. We're recording this podcast starting a month of February, and we got a lot going on at Tackle Trading. Matt, tell us what we got going on in the month of February.
Yeah, I definitely bookmarked the live events page. It's in the description below. We got a few events coming up in February. You can see on February 19th, I'm doing a precision trading webinar. The art of swing trading is what I'm going to be talking about. And so if you want to learn a little bit about swing trading and definitely technical analysis, sign up for the February 19th webinar. You also have Master Trader at the end of the month for the pros. And then we have a YouTube event on February 10th. With Coach Dino, who's going to be talking a little bit about trading orders, setting OCO bracket orders, and making the concept of putting in those orders a little bit more simple for our community as well. So got some exciting webinars coming up in February, and definitely check them out on the live events page.
Yeah, listen, looking forward to all of those. Looking forward to this podcast. Going to enjoy the conversation with you, Matt. What we're going to do in this podcast is we are going to chronicle the week that was. We're going to start at the start. There are some interesting storylines in this week, and it started off with a bang on the Sunday night futures. When you looked at the futures on Sunday, and then if you followed them into Monday, you knew that the market had a hold of a story, right? It wasn't normal price action that you would see without some kind of narrative driving force. That driving force was DeepSeek, and it spurred a massive amount of conversation in the market in the initial days, in the middle of the week, at the end of the week, and for the weeks to come. Matt, recap what this story was for someone who isn't very well versed on it.
Yeah, it was an amazing story. I was trying to find the right word to kind of describe the event because
go to DeepSeek, say what word do I need to describe?
They won't describe anything about the Chinese environment in any negative terms. I do know that. But what they did do is they put a shock wave throughout the entire AI infrastructure development. And what the news was DeepSeek, which is an AI startup out of China. And DeepSeek's been around for about a year. They've been producing their own version of their chat GPT, their LLM. Now, an LLM right now costs about $80 million, upwards of $100 million to really kind of develop, because you need, as of before DeepSeek kind of came out, what the kind of the belief is that you needed the highest end chips kind of being produced by NVIDIA to be able to produce the content necessary to produce the LLM. Well, that's why it would cost upwards of $80 to $100 million, because those GPUs out of NVIDIA are extremely expensive, and they're also restricted from selling into China. And so there was this assumption out of the United States, and quite frankly, rightly so, that we were, I don't want to say leaps and bounds, but we were definitely well ahead in the AI arms race between the United States and China. Well, the DeepSeek news kind of threw that analysis out of the equation, as now DeepSeek has the exact same, I don't want to say the exact same, but very similar quality and capability as what we see out of OpenAI and ChatGPT, but they say it was built on $5-6 million infrastructure. Now, I'll be the first to say this, Mark, that I highly doubt it only cost $6 million to develop their LLM. I'm fairly certain that's what they have to say, because they can't talk about some of the other things, because NVIDIA's chips are certainly restricted. But that's an open question, whether or not it costs 6 million, or whether it costs 60, or whether it costs 30. What we do know is they were more effective and more efficient in the development.
And I heard that word throughout the week, efficient, right? Like whatever the cost was, they were more efficient. That became one of those constants in the debate that even bears, bulls on both sides of the equation be like, all right, we can agree on
Well,
that
and you
particular
knew
point.
that was going to happen, right? You know, as the development of the AI infrastructure gets built out and technology improves, well, other innovators going to come on top of already designed infrastructure, and they're going to try to improve upon that. And so you know it's going to get cheaper. You know the build out's going to be more effective and more efficient. Technology is a deflationary area of the market. Everything else is inflationary, but technology is deflationary. And so you know it's going to get cheaper over time, but you didn't know it was going to happen in this moment in time, that quick, that fast, that efficient out of China. And so DeepSeek threw this nuclear bomb in the AI trade in the market on Monday, and there was a quick sell everything first moment because nobody knew exactly what was really happening. And specifically on companies like Nvidia obviously is the linchpin of the AI trade and the end all be all because they had that chip that everybody needed. Well, now with DeepSeek, there's open questions. Do you only need NVIDIA's chips, or can you develop AI LLMs on a less effective chip design, such as gaming chips, instead of just the AI build-out chips? And so it opens the door to more competition. It opens the door to more startups. It opens the door to more companies coming in and competing in this environment. Because if it was commonly understood that it cost $100 million to develop an LLM, and now they're doing it for 5, 6, 7 million. And again, I think it's more expensive than that, but you do get the point. It's cheaper. It does open that door up. And so NVIDIA took a hit. Semiconductors got absolutely rocked. But as the market went on, Mark, the ultimate concern of, is this going to change CapEx spending? Because that's what the real concern for the market was we're expecting 300 billion in CapEx spending. Meta just came out a week ago and said they're doing 60 to 65 billion in CapEx spending. Microsoft and all these other big tech companies saying the exact same thing. That's what equates to the 300 billion in CapEx spending. Well, after Monday's DeepSeek, that was a concern. Well, as we kind of navigated the market, I don't know if that's a market concern any longer, because we heard from Microsoft this.
Yeah, and we'll talk about them. I want to stick to our
I'm just saying
chronicle.
the concern now on DeepSeek isn't necessarily the CapEx side of the equation. It isn't necessarily, for example, Meta, because if Meta doesn't have to spend that much money on CapEx spending, but they can develop the exact same type of technology, that's an efficiency argument for Meta. That's not a negative argument for Meta. And so the only point I wanted to make with the Meta and the Microsoft CapEx is the ultimate concern on that is kind of null and void at this point, but there is still concern on semiconductors. And this DeepSeek news is still an impactful story for specifically semiconductors and, quite frankly, NVIDIA.
Yeah, and we're going to talk about this throughout the podcast. We're going to bring it back in. One of the things I found interesting on Monday, Matt, in market reactions, because you know me, I'm a self-proclaimed thematic, narrative-driven individual. And most of the time when you have negative market reaction, for example, let's go back to the last red candle we had of size to the Fed meeting in December, right? It's like markets know how to process the information. Right. It's the Fed is hawkish, and then they dive into their playbook, and you see it almost like within a few days recapped it, and then within a month it had never happened. Right. So, like, if there are banking problems like we had in March of 2023, the market has seen that before. They knew how to react, reprice, adjust when the Fed turns hawkish or dovish or whatever. Monday, it had this feel of, what are we supposed to do? What's the debate? And there was just genuine, like, just dialogue in every corner of the investing universe. What does this mean? Not just for today, but for like 3 months, 6 months, 12 months out.
There's concern obviously on the semiconductor side of the equation still, but there's still a lot of open questions on the AI build out. And that's not exactly a conversation for what's happening with the price action today, but where is this fundamentally macro story going on in 6 months from now, 12 months from now, 2 years from now, from by the 2030 and 2030 kind of target dates? How does this impact AGI and the development on the infrastructure side on the race to AGI. Well, Mark, to me, and I can't remember who gave the analogy, but on day one of the DeepSeek news, they had that they called it a Sputnik moment.
It was Goldman. Goldman
It
put
was
that
Goldman.
out there.
Okay,
Yeah.
so they called it a Sputnik moment, and that made a lot of sense,
Yeah,
right?
you and I had private conversations
Yeah,
on this.
because you think about Sputnik, and for those of you who maybe don't know what or familiar with what Sputnik was, in the late 50s there was a space race going on, and the race wasn't China and the U.S., it was the U.S. and Russia got there first, and that sent shockwaves into the United States because it was understood at the time that the U.S. was in front of Russia. And that proved that the U.S. was not, in fact, in front of Russia. Same thing kind of happened this week on DeepSeek with the AI race. It was commonly understood that the United States, and I kind of eat, sleep, and breathe this AI
This is
and it was
absolutely
commonly understood that the United States was well in front of China in any development of the AI arms race and the race to AGI. DeepSeek threw a wrench into that, and I wouldn't say now they're in front of us the same way that people in the late 50s assumed that Russia was in front of the United States. I would still say the United States has a healthy lead on the infrastructure build out, and maybe not on the race to LLM, but the race to LLM is not the race. That's the infrastructure that all this technology gets built on top of. And so the race is to AGI. What China and DeepSeek did this week is they reminded us that it's a close race, it's not over, and we need to double down and reassess where we're at. The same way we did in the late 50s, early 60s on the space race. And by the time it was all said and done, we won that space race. And by the time it's all said and done, we will absolutely win the race to AGI, because I think that's
competition breeds innovation.
Oh, it forces that innovation.
It forces it because you cannot lose this. This is an AI war. I saw Bloomberg. I saw Deutsche Bank. I saw a lot of people step out of the trees looking at the forest being like, listen, this will breed more innovation in AI. This will speed up the process.
Absolutely.
And so it was fascinating week on the narratives, and I want to revisit that in a second.
And I'll just say this one thing about DeepSeek. DeepSeek was an IPO company a year ago. They've been around for about a year. Mark, breeding this competition is going to allow the development and implementation of new product ideas, new companies, new fostering competition, and obviously those are going to be targeted by the big dogs to get gobbled up through acquisitions, but it will spur innovation, and that's my general point. Competition spurs innovation. I think this was a shock and an awe to the U.S. Developers of AI. But I think the U.S. developers of AI understand what the importance of this conversation is all about. I think they're going to double down, and that's what we saw at Meta, Microsoft, and a lot of the CapEx giants this week.
Yeah, no, and we're going to talk about a few things that happened this week: tariffs, the Fed, different things that have impacted different areas of the market differently. But I want to focus on the price action. Will you give me the equal weighted index for those watching on YouTube? If you're listening, we're going to talk about the price action on Monday, because this was something that stood out from a just understand what is happening, what areas are impacted. You and I were on this in the Tackle Today on Monday in the Traders Lounge, where it was like, listen, this is not a market story. Yeah. And it felt like one of those, this is a market. And we were very clear, and we'll be very clear here. That now maybe tariffs and the Fed and you and I, when we converse, they're more broad-based. Yeah.
Tariffs.
But DeepSeek was not a market story.
No.
It was a very specific to certain areas of the market.
Industry story. It was
It was not even a sector story.
It wasn't even a tech story. It was an everything story for about 3 seconds at the open on Monday. By 30 minutes into the open,
it was obvious it was not
story. By an hour after the open, it was a specific NVIDIA and secondary build out, anything tied to NVIDIA in the build out, like ASML, for example, Taiwan Semiconductor, other secondary semiconductor companies like AMD. And so, but it was an industry story, and from that point on, it has been an industry. DeepSeek is an
and it will remain. Like DeepSeek will not be a market story.
You're not
It
going
will
to be
be
concerned about DeepSeek when you're breaking down energy later today.
no, you are not. But so on Monday, your average stock was unimpacted, did not trade on it the rest of the week, will not. But as you mentioned, there were a few areas, obviously NVIDIA. And let's talk about NVIDIA for a second, because when you look at this week, NVIDIA was from just a narrative. I'm not talking, I don't want to break down fundamentals and what you can do all that. But just from an easy to understand narrative perspective, for me, there were a couple clear losers. One was NVIDIA, not semiconductors necessarily. When we talk about ASML's earnings Wednesday morning, we'll talk about that more specifically. But from NVIDIA, there's like NVIDIA had this chip dominance. And I am not here to say, well, this or that on the future of NVIDIA. I'm just talking from an easy to understand narrative perspective. If you need less and can do more with less, the king dog, which is NVIDIA, well, that's impacted from just an easy to understand. You don't
have to spend $18,000 on an NVIDIA AI built out GPU, but you can do it for a 4,000 GPU. I think that impacts NVIDIA's revenue stream. Yes.
Yeah. And if you don't need the power necessary, because Monday became a do more with less type theme. And that never really was refuted during the course of the week in any of the analysis. Give me CCJ, the uranium, right? Because from a thematic standpoint, some of those areas of the market that were basically, you know, really tied into the conventional outlook, I guess is the best way to describe it. This is how AI is going to proceed, right? Because AI proceeding, that's not in question.
No, nobody's. No, it's faster now.
It is. A week ago, we had a conventional model. Oh, we're going to have to build out tons of data centers, and it maybe play out that way still. But it was like universally accepted, whereas now there is debate on the matter a week later. And so things that were needed for that build out, you mentioned Taiwan, you mentioned NVIDIA, obviously, specifically, uranium, power.
Yeah.
These were the industries that were impacted by Monday's
anything
news.
On the downstream of the AI trade got rocked on Monday. Anything in the downstream. And most people at Tackle Trend pretty familiar with the downstream on the AI trade. We talked about it quite a bit, but anything got impacted there. The ultimate question is not does it obviously DeepSeek was a big time disruptor here, but does it change what these companies are planning on building out 5-10 years from now? DeepSeek's not the end goal. An efficient LLM is not the end goal. The end goal is automation, robots, the AGI. That's the end game. DeepSeek obviously pushes the ball further and forces more innovation, more competition, and so on and so forth. But does this ultimately change kind of what is going to be needed downstream on the build out? Is it going to take as much power to build out the AI infrastructure? Most likely not. But is that a negative thing? I don't see that as specifically a negative thing. Is it negative in the short term for high valuations in the current price action? Yeah, it is. But long term, I don't see it as a negative.
Yeah. All right. I'm going to come back to that in 2 or 3 minutes. Now, this dominated the conversation on Monday, right? And rightfully so.
Tuesday too.
Yeah. Now, Monday, in other corners of the universe, Scott Bessent is confirmed as Treasury Secretary, one of the most important positions in the world. Now, the Financial Times put out an article on Bessent's view on tariffs, where he says he wanted to start. Now, Scott Bessent has been a proponent of tariffs, the use of tariffs. He is squarely in the we need to use tariffs. Now, the Financial Times put out an article that was not refuted by anyone that said Bessent.
I can I just clarify something on Bessent? I have not taken Bessent as pro-tariff. I've taken Bessent as pro-strategic tariff.
Yeah, and that's what this article laid out, is that, starting
there's a big difference on strategic tariffs versus broad-based tariffs.
At 2.5%, something that could get pushed higher and that would be a very gradual process. Now, markets love gradual. They get to see the economic reaction, right? And so this was a very friendly market story on tariffs. Now, President Trump on Monday night was speaking in Florida, and a lot of this was lost. It didn't get any of the headlines.
DeepSeek was dominating headlines on
Now,
Monday.
it was hard. I mean,
the
this was
Treasury Secretary got confirmed on Monday, was talking tariffs, and it just got completely washed out of the market because of the conversation on DeepSeek. It was that big of a shock DeepSeek was. But
no,
continue. I'm sorry.
Yeah, no. And President Trump on Monday night, though, came out and said, I want bigger across the board tariffs that are much bigger, in emphasis, much bigger than 2.5%, basically saying, that's nice, I want more, and then basically threatened to tariff semiconductors and metals and pharmaceutical goods. Now, we're going to come back because nobody was talking about that story on Monday night. Nobody. It happened. Now, they would be talking.
It happened, but I'm telling you right now, like, I caught some news of it on Tuesday morning and I did not care. Like, I think I saw Bessent's 2.5 headline. I'm like, well, if that's the case, nobody cares about that. Like,
yeah. And this is me. And so that happened, right? Nobody cared about it. They would care about it a few days later. It would become more of a market story.
Yeah, nobody cares 2.5. Everybody cares at 25.
So Wednesday morning, you were going to have ASML earnings. You're going to have a Fed meeting in the afternoon with the Powell presser, and then you were going to have a trio of very important earnings reports with Tesla, Meta, and Microsoft after the bell. Now, ASML started the day right. You can talk about the specific numbers. There were a couple things that the CEO said Wednesday morning that really resonated with me, where he, in simple talk, very plain English, said, listen, the DeepSeek news is great news for his company because it means overall more semiconductor cells as AI, a lower cost AI, can be used in more applications. More applications means more chips. So at a very simple, explanation of why DeepSeek was great for them, right? Because more chips means they get to sell more products than they're doing, right? And it kind of separated out maybe some winners and losers from the space itself. What was your take on his commentary, ASML earnings?
I thought that was the only way the CEO of ASML could describe the earnings, because they tried to, half glass full. Hey, increased competition is going to be beneficial for us. The only question I would have is, but you have a monopoly on selling the AI high-end chip. They don't have a monopoly on selling low-end AI chips, and they have the technology to develop the chip needed for the NVIDIA high-end GPU. If other chip manufacturers, like outside of ASML, let's say Lam Research, for example, I felt Lam Research later on the week had a much better report than ASML, and quite frankly, what the CEO of ASML said would be far more beneficial for companies like Applied Materials out of the United States or Lam Research out of the United States that also deal in the semiconductor infrastructure side of the equation. So I understand why the CEO would say that, but the ASML strength is in the high end. Increased competition would increase the low end, which would be more beneficial to Lam Research, LRCX, which is, quite frankly, a Tackle 25 stock going through a reversal in and of itself, similar to ASML, or something like an Applied Materials, which is also going through a little bit of a reversal in and of itself. So I see it a little bit different than the CEO of ASML, who's trying to paint the rosy.
So you like his argument, but not his argument.
I like his argument for Applied Materials and for the competition. Yes, I actually really like his argument for Applied Materials and Lam Research over, say, over ASML. So again, that's the only thing they can say after the shockwave that DeepSeek presented on Monday. I totally understand it. I think it's a compelling argument. I just think he made the competitor's argument for them.
Yeah, well point. All right, so then we're going to head into the Fed meeting. Now, there were a lot of little important news stories lost this week. Before we even got to the Fed, there was a burst of volatility in the market Wednesday morning when the White House announced that NVIDIA, that they were looking to restrict NVIDIA chip sales to China. Once again, one of those stories that I mean, it just got lost in the thing. I have a feeling that there's some teeth to that story after the DeepSeek news. Something that in the weeks to come, we probably will see a further announcement.
Further restrictions are coming to chip sales to China.
They just are. They just are.
Listen, there's going to be things I agree and there's going to be things I disagree. I'm going to be very open with the things I agree with, and I'm going to be very open with the things I disagree with regarding what we're going to be doing from an AI build out, the infrastructure, the trade wars, and everything. And obviously, there's going to be sometimes people agree with me and sometimes they don't. But that's why we have these compelling conversations. I will not disagree with one aspect of restriction of selling chips to China. Not one. It is that vitally important that we win this AI arms race to AGI. So, I think it's coming and I think it's needed. And by the way, I think DeepSeek got around restrictions. I think that's one of the untold stories in the DeepSeek saga is how they got around restrictions, because and again, things that I cannot prove that I know to be true, DeepSeek got around restrictions.
Yeah, and if there is a teeth to this, there will be investigations to make sure that those are thwarted. Those things.
Somebody had to get DeepSeek those chips.
Listen, NVIDIA came out of this week a loser.
Absolutely.
They just did. They just did. But they just did. There's no way to spin this one.
Out of all the DeepSeek, all the disruption DeepSeek brought to the market this week, it was NVIDIA that is the clear concern. Out of all the concerns in the semiconductor areas of the market right now, DeepSeek concern number one is NVIDIA.
Yeah. All right. Okay. So we get to the Wednesday afternoon. The Fed comes out. Here we are on the podcast halfway through. Haven't talked the Fed yet on a Fed week. And there was a reason. It was a busy week.
DeepSeek was important to talk about and understand.
It was a busy week. So Wednesday, the statement is released at 2 p.m. Eastern, and it was a hawkish statement. In the statement itself, they paused rate cuts. They talked about labor market strength and removed the reference to inflation progress on the statement. There was a negative reaction in the market on the statement. When you change language that is, tilts to the hawkish side, you're going to have a negative reaction. Now, Powell comes out, and we all knew that the statement was kind of inconsequential. Powell comes out 30 minutes later. Now, Matt, before I get into my take, I want to get your take on just Powell, his message, what your take was, because you and I watched Powell together. Mm-hmm. So I already know what it is, but I want you to share yours first.
I kind of felt like he punted. I think the number one thing I think we all felt like Powell was going to do is rely on data dependency in this one. It was obvious that they weren't going to do anything on the cut or an increase. Increase isn't part of the conversation, but I think it was 99.5% of economists polled before the event expected no rate cut. And so there wasn't really a rate cut conversation on Wednesday, but the reduction of the improving condition language on the policy statement was a little bit, I don't want to say abnormal. That had to be reduced. Obviously, that was that part of the policy statement was describing an element where inflation was coming down from 3.5% down to 2.5%. Now you're kind of in that sticky 3% range. You had to reduce that language on the improving condition, and so that's where the slightly hawkish lean coming out of Powell comes with. But at the end of the day, I felt like this was a punt just kind of relying on data dependency without any real discussion on kind of the path of policy. I don't know more today about the path of policy than I knew last week, and I think that's a problem for the market.
And that is, for me, I've been around you long enough to know that when monetary policy is unclear, you don't like that. You don't like that. And you speak for the market when you do that, because the market doesn't like that. My son texted me and was like, Powell hawkish, and I'm like, and my response to him was like, no, but he might as well been, right? Like, he wasn't hawkish.
The absence of dovish language was enough to propel a slightly hawkish read coming out of the Fed. There was expectations because of kind of a couple speakers' conversations coming into the Fed that he would be a little bit more dovish. I felt like he was calling balls and strikes a little bit, data dependency. I think he could have painted the environment however he wanted to paint the environment right now. And he had no concern on the labor side. He talked about the difficult battle to get inflation down to 2%. Obviously, it is a very difficult battle, a battle we've been battling now for 2 years, and I feel like we're going to battle for another couple of years.
Yeah, and so like this puts extra emphasis. Economic reports. This was one probably if someone were to ask me, what is your one takeaway from the Fed this week? I'm like, economic data has not mattered for 2 months. That changes moving forward. Like for 2 months, markets have been trading on macro, on this, on that. They've ignored economic data, and rightfully so. We haven't criticized markets for that, right? There's been a lot of moving parts. Moving forward, that changes. Economic data will be because the Fed doesn't have a clear message.
Well, and I think specifically anything on inflationary data becomes ultra important.
Specifically.
Yeah, because again, I don't think anybody in the market post Fed and looking at the current inflationary situation is expecting a redo of 22, 23. Like I don't think that's in the cards here, where you saw inflation go from 2% all the way up to north of 9%. Like that's not what we're talking about. But the sticky part of this conversation, it was always going to be sticky. Mark, I remember talking about this 2.5 years ago, and what did I say 2.5 years ago?
That last hundred, you said the last 1% is going to be a real bitch to try to get.
And where are we at? The last 1% is a real nasty thing to work out of the equation, and quite frankly, I also think the target of 2.5 to 3% is actually the real target, and we've seen the Fed take off their brakes a little bit. I will say this one thing about Jay Powell on Wednesday. It was interesting how he described a 4% interest rate being sufficiently restrictive. That amazed me, quite frankly. Mark, it was just a year ago they were arguing 3% was neutrality. We're at 4% right now. I think it's the most ridiculous thing to suggest that the Fed is significantly restrictive right now. If the Fed was significantly restrictive right now, the market wouldn't be kissing up against an all-time high. And
save that thought, Matt. Michelle Bowman in our Chronicle on Friday morning had a few things to say about that. So save that anger.
Yeah, I just
harness it.
I just don't understand the restrictive language. It's not. It's slightly okay. I'll save.
Yeah, Michelle Bowman is going to agree with you on Friday morning when we get there. All right, so Fed, might as well been hawkish in my world, economic, especially inflationary data. That's what the big takeaway on that. But then we get to Wednesday night, right? And we got this trio. Break down these for us, right? So let's talk IBM earnings, how important they were to the market. Okay, never mind. I
was going to say, I'm already bored.
All right,
don't get me wrong, IBM had they launched this week.
I know, listen, I was just,
But if you wanted me to give you IBM's analysis, it's going to be a lot of felt like a doji to me.
Yeah, I got it. Anyways, I wanted to have fun with that. All right, so we have Meta, Tesla, Microsoft. Walk us through CapEx, some of the storylines, the actual numbers on a good trio.
I think the number one thing I was looking for out of the trio of this report, and really kind of Meta and Microsoft on Wednesday night, was were we going to see any reductions in R&D? Were we going to see any reductions in CapEx? And we didn't. They reaffirmed on that side of the equation. And so that concern on general CapEx spending coming out of DeepSeek, that's I don't want to say there's no concern, but it's not nearly the concern as it was.
Because just like countries cannot lose the AI war, individual companies cannot afford to lose either.
No, they cannot. No, they cannot. And they're going to throw money at it, and they are throwing money at it. I'll take these one by one. I felt like Meta out of the three was by far the best report out of the three. Meta had a substantial beat of about 20% against consensus on EPS. Revenue was a clear winner, up as well, up over 20% year over year. And they announced secondary announcements on dividend and an additional $50 billion in stock buyback. I mean, Zuck's putting money to the AI trade, and obviously coming through pretty decently here. I felt Meta was the clear best report out of the Mag 7 this week, and I do not feel there was a close second. When you're talking about the other two, obviously a little bit different. When you're looking at Microsoft here, Microsoft, whereas Meta was beats everywhere, basically pulling off hat trick on Meta, Microsoft was the inverted of that. Came in line on EPS, revenue was close to in line as well. Azure was underneath the expectations. That in some regards, you can actually argue that they missed on EPS mark, and 77% of companies right now are beating EPS. And so I just felt like Microsoft was the worst of the bunch this week from a general big cap, mega cap tech company. Microsoft, I felt like the market got it right here this week. Microsoft, you traded a premium, and you got to, and yes, you have a tremendous amount of value and you have a tremendous moat, but you got to grow. When you're trading at the premiums you're trading at, you got to give hope for the future. And I just didn't see that in Microsoft's report this previous week. On Tesla, I personally felt like hope carries the day on Tesla. I felt like this was a negative report. I felt like it should have sold off fairly aggressively. Tesla.
Let me break down every social media conversation on Tesla. Valuation's too high. Earnings reports suck. You don't understand. It's all about the future.
And that is exactly what transpired on Tesla.
That is every social media debate on Tesla right now.
That is every social media. I was going to say it depends on the social media channels you're looking at, but that is pretty much the synopsis of the Tesla conversations post earnings. But I would say that was the Tesla conversation during the conference call as well on Wednesday. So that's kind of what Elon did on Wednesday. And I get it. When you don't have an EPS to brag about and you don't have a revenue handle to brag about, if you're a growth stock and you want to appease the investor class, you got to be talking about the future, and they did. Now, on that future, FSD had some interesting updates on FSD. That's the full self-driving, the automation out of Tesla, and that obviously is a clear winner. They talked about robo taxis and fleets of automation, and yes, they've had that conversation last quarter and the quarter before and the quarter before and the quarter before. So I kind of feel like enough talk. You got to show a little bit. And I just didn't feel like their earnings justified their high valuation, especially with the front run in the quarter mark. I mean, you're talking about ever since the election, you're talking about a stock that's went from low 200s up to 480. They were coming in at about $400 on the print. You're talking about a very high valuation right now. I just personally didn't feel like they justified the high valuation. I'd be a little concerned on any potential violation of support, because the bigger they grow, you violate support, they have a tendency to get rocked in the short term. So I have a little bit concerned on the shifting volatility at the top, lack of overall real numbers to drive the conversation here. And that's in a year, 2 years that have been pretty nasty for EVs. And so Tesla in general is leaps and bounds and a billion times better than some of those other EV companies out there. But at the end of the day, it's been a tough space for the EVs, and the raw numbers is what that reflects, right? That's what their raw numbers reflects, is the EV space. The hope is on the future of FSD and the full self automation.
Yeah. So we get through earnings Wednesday night. It was a big day. Everyone had a beer on their porch, even though it's winter, because it was one of those days you just didn't carry anymore. And then we get to Thursday morning, markets digesting the information. Precious metals break out on Thursday morning pretty strong. This was like in the price action of things, when we looked at gold, when we looked at silver, it was they stood out Thursday morning, right? They stood out Thursday morning. Talk about the technical breaks here.
Yeah, I think you got to like what you're seeing on the commodity side of the equation. The precious metals, industrial metals, both gold, silver, kind of doing a little bit of the same thing from this breakout over the course of the last couple of days. When you're looking at gold GLD here, obviously /GC, you're talking about breaking out of all-time high prices right now with momentum here. You had a pretty good little secondary development pattern, a little bit of consolidation often goes a long way. On Wednesday, you gapped up, you kind of kissed up against that all-time high right around 2,800. And then on Thursday morning, you blasted off. That's a momentum situation on gold. And when you're looking at GDX and you're looking at some of the miners there is a little bit of a catch-up philosophy here, especially as basic materials starts to simmer down on that selling program we saw all last December. Obviously, a deeper retracement here as well. And so you got something cooking a little bit on materials, quite a bit on gold. And so there's just a little bit of a philosophy on the gold miners here with a little bit of momentum catch-up philosophy. On the silver side of the equation, obviously very similar in terms of the Thursday, Friday price action. Thursday gap out because silver really started trending hard throughout the overnight action. Friday, a little bit of a pullback situation. I think silver's got to be on the radar. If you're not already participating here, I think silver's got to be on the radar for any secondary development, whether you're talking of a flag back down to 28 or some type of cleanup against that intraday resistance level. GDX looks like a momentum situation above the highs of the week.
Yep, absolutely. And this is, I think, one of the things, and we won't have time to talk about it in this podcast, that even if there is market volatility, there's going to be areas of the market that you want overexposure to. Precious metals has that feel to it. It just does. Thursday night, Apple earnings. Talk to me about them.
Apple's earnings, and again, sans any major announcements coming out of Apple, I felt like they came in line fairly decent on their raw numbers. I didn't get the gap out situation on.
Listen, I love how you describe this. I don't know if you did it in a live program or it was just internal. You're like, I like where it ended up. I don't like the path.
I don't understand the path that it got there. That's basically what I said.
I thought that was fun.
I felt like it was a doji report. I didn't feel like it should have inspired anybody, and yet
it became a doji report. Just an interesting
gapped up, and so basically what I said was, I think the price is right. The path that got there, I think, is a little bit suspect, and that's kind of how I currently feel even today. I think it blew up a pretty good developing technical pattern too, and I think that's why I probably described it that way a little bit. Now you got to deal with some overhead there, whereas it was getting a little bit cleaner around that 240 level for anything post earnings. Now that's got to get cleaned up a little bit, but in my estimation, Apple was not inspiring this week. Meta wasn't inspiring this week. I felt like some of the better reports, Meta was Microsoft wasn't inspiring. I thought Meta was a good report. I thought Lam Research was a good report. I thought EAT had a great report coming out of last week. There were a few rock star reports last week. They were just not from the Mac outside of Meta. They were not from the Mac 7 components.
Yeah. Thursday night, the Wall Street Journal, not the last time we will mention the Wall Street Journal in this podcast. They had an interesting headline this morning that we'll talk about. But Thursday night, they put out a piece that was, once again, kind of in this like Scott Bessent positive vibes on tariffs, saying, listen, administration could announce new tariffs by Saturday, but with a grace period before implementation to allow for negotiation. So they put out that piece on Thursday. Yeah, that didn't happen. But I wanted to highlight that because coming into Friday, all of the tariff analysis was very, it's coming, but there's going to be this gradual. It was very conservative. The market was not ready for the baseball bat, right? It wasn't. We'll get into that here in a second. Friday morning, PCE inflationary data comes out. It's a nothing burger. Heightened awareness, but you basically was a doji report. Market basically ignored that. Michelle Bowman, though, and we said we'd get to these comments on Friday morning, stated what you were saying here a few minutes ago. It's like, it's not clear monetary policy is exerting much pressure on the economy, with easy financial conditions and high asset prices probably slowing progress on inflation. Fed member calling out the Fed.
I thought it was asinine for Jay Powell to paint the policy as of right now as significantly restrictive. I thought that was absolutely asinine on Wednesday. For 2 years, for about 12 years, I heard net neutral was between 2.5% and 3.25%. Then after the pandemic and all the hoopla of inflation, I heard net neutral was around 3.5%. You're at 4% right now, 4%. And you're talking about significantly restrictive at 4%, when just a year ago you were saying neutral was between 3 and 3.5. That's not significantly restrictive, not from a monetary policy perspective. Volcker is crying on, probably not crying, probably very angry on that comment about significantly restrictive, when he's like, hold my beer, I'll show you 16 tomorrow. So I just felt like that comment was just absolutely out of place, and not a truthful comment coming out of Powell regarding the significance of the restrictive territory. I think he was trying to set up, basically cuts with the appeasement of further cuts. But to me, we're not significantly restrictive. We have not been significantly restrictive in well over a year on monetary policy. We've been going through a pause. We've been going through a slight cuts. And then on top of that, you had Janet Yellen for 9 consecutive months last year, as they were going through the pause, flooding the market with monetary policy. And so monetary policy and the restrictiveness of monetary policy is not just the rate, but to describe the rate as of right now at 4% is significantly restrictive, whereas they've been doing other things outside of that to shore up the market over the course of the last year. Listen, there's a reason the last percent is difficult, because nobody wants to do the things that are absolutely necessary to do to get it down to 2%. That's why we all have to deal with further inflation all the way out to 27. And so there's a mathematical equation to all of this. And I'm sorry, 4% is not significantly restrictive. If they were truly, honestly battling inflation, we wouldn't have been in a pause for a year. We would have been continually, we would have never embraced rate cuts to begin with. We would have kept the rate where it was. Janet Yellen wouldn't have opened up the floodgates of monetary policy, and we would have been 2% already probably a year ago. None of that transpired. None of that's transpiring right now. This fight against inflation from 3 to 2%, I think it's the biggest, most fakest shit I've ever seen in the history of inflation in our marketplace. They're saying battling at 4% is restrictive. This is absolutely ridiculous to me when you have the historical context of what truly restrictive monetary policy is. This isn't it. I feel like we're having a moment where somebody's talking about monetary policy. And if you remember back in the day when they said, sir, I knew JFK and you are no JFK, Jay Powell, sir,
Bessent,
you are no Paul Volcker here. You are not restrictive in any capacity. You have multiple historical mistakes on your plate over the last couple of years. And quite frankly, I feel like the mistake he's making right now, in terms of not significantly battling inflation, is going to hurt very dramatically down the road. So I just feel like this whole conversation of, oh, we're restrictive, I just feel like it's gaslighting. It's not a truthful statement in any historical comparison.
Yeah, no, and obviously Michelle Bowman, you have Fed members turning on Powell. You've seen dissents the last couple. I think you're going to have a more fractured Fed than you've had in a long time. I think you're going to see multiple dissents on different things moving forward, especially if they try to cut. Well, we'll see how that story unfolds. Matt, so we're a couple hours on Friday. Market's about to close. It's boring. Price action's boring. And then I saw a big red candle on my 5-minute chart. I saw a big, it's like just boring, man. And I'm like, and all of a sudden I saw a big red candle on my 5-minute chart. And then I saw a follow through candle. And then I was like, okay, what's going on? There's a news. I was like, I know my 5-minute candles, right? And I know algos. And I was like, what's going on? Well, the White House announced that it would slap 25% tariffs on Canada and Mexico, and an additional 10% tariff on China. Carolyn Levitt announced that in a Friday press briefing. And
rookie move.
And that was it. My initial thing is
rookie move.
Janet Yellen would have never announced a major negative policy announcement 2 hours.
Of course, Janet wouldn't have. The first Trump administration never would have announced a major economic initiative that was going to be negative to the financial markets 2 hours before Friday close. They would have news dumped that on Saturday or whatever the case might be. No, they were cheerleaders to the market in the first go around. That's a little bit
And
different.
this was not someone who the market is not on top of their mind, on the middle of their mind, or it is like they're not even thinking about the market.
Not yet. They're not.
Yeah, at 5,200, they'll think about the market. They'll be a little bit more careful with that.
10% down, but as of right now, no, I for someone who you would think would be a little bit more concerned with market reaction, there was no concern over market reaction on the tariff news over the last week. You go from 4 straight days of talking conservative language on tariffs, with Bessent coming out and talking about
Bessent, Wall Street Journal article.
The Wall Street Journal, all of that was about conservative 2.5% in 2 hours before the market closes. You get rocked with 25% tariffs on not they didn't go in on Friday, but the announcement was on Friday. 25% tariffs on Mexico, 25% tariffs on Canada, and then an additional 10% tariff on China is what I think it was. Now, I do believe they stopped short of giving us the specific details on everything that was going to get tariffed, correct? Like, we don't know.
Yeah, no. Now one of the big things,
or specific to industries yet, correct?
It was like the selective targeting, the slow rollout. These were the things that were anticipated, that were detail lacking on that.
Yeah.
They were detail lacking on that.
Well, detail lacking for the financial markets always equates to a sell. Like, it just does.
Like markets hate uncertainty. We know this. And so it feels like a sloppy announcement. In fact, the Wall Street Journal today had a headline. Now, Wall Street Journal, not exactly a liberal bastion.
Very, very conservative, I would call them.
Called it the editorial board had an article stating it is the dumbest trade war in history. And the reason they call it the dumbest trade war in history, and once again, the Wall Street Journal is a conservative organization, is the lack of detail. It's like, what's the purpose here? What's the plan? Right? Markets do not like, and Matt, if you have the Wall Street Journal saying that, all of a sudden you're going to have the Goldman, the JP Morgans.
The concern is Wall Street Journal allows other people to come out with criticism on it, and that would open up a floodgate of a little bit of criticism. But there's no criticism like the market actually showing you how they feel about the announcement. The market sold it fairly aggressively, wiped out good development on the technical side of the equation, and quite frankly, dirtied up what could have been a really, really, really clean breakout attempt against that 610 level. Now, the 610 level is still really clean on the breakout channel. The 595 support level becomes very, very, very important here. There's no doubt about that. A little bit of a K-trade vibe between 610 and 595. In the newsletter, basically, I was talking about, okay, that next, test of resistance at 610, it's battle tested is 610. 595 support level, not exactly battle tested. And so you could see some volatility this week. And we do have 132 earnings reports coming out of the S&P 500 this week. So expect more volatility this week, especially with with Friday's tariff announcement. Now, I think they will try to clean up that language, Mark,
you would think
out of the tariff announcement, because I can't disagree with the Wall Street Journal as of right this very second, because tariffs in and of themselves are not net negative or net positive. Tariffs in general are inflationary based, but if you're going to target certain industries such as oil and gas or steel or manufacturing or semiconductors, for example, and you want to bring that development back home, tariffs are a great way to encourage the development of all of that to come back home to the United States. And so I'm not anti-tariff, not pro-tariff, but I am anti-broad-based tariffs, because broad-based tariffs are truly just inflationary based, and they really don't create any any degree of long-term solution to any problem, quite frankly. And so when you're looking at these tariffs, there's some obvious open questions right now. There's some obvious concern against them right now. But I just want to ask you a question, Mark. There's always a reason why you're going to do some degree of tariffs, whether you're threatening, negotiating. I don't think we can take that as a negotiation or a threat. That there was an announcement that is happening here. But you're targeting something. I understand the Chinese tariffs. In fact, I think we can go even further on Chinese tariffs. That's how much I think it's important.
We're in an economic war with China.
Semiconductor development and infrastructure in the U.S., and we have to be open about that as a society. We are in a cold economic war between the United States and China. And we don't talk openly about all the things that China does, but in terms of the United States, it's important for us to control that development, and tariffs are a great way for us to control that development. And so you want to announce 50% tariffs on China. Yeah, would it rock the semiconductor development in the short term? Yes, but would it be beneficial for us as a society long term to develop that stuff internally? Absolutely. Also, I want to say this about tariffs. Post-pandemic, the common understanding was countries were going to get more isolationist post-pandemic.
It's been a trend for a while
because we couldn't get certain things because of the global economy was shut down. And so I think you're seeing the secondary situation starting to occur on the isolationism a little bit, and tariffs are targeting certain industries to bring them back home, like pharmaceutical development. After the pandemic, Mark, do you want to outsource pharmaceutical development to other countries around the world, not named the United States? Probably not. So again, if you're targeting a specific industry for a specific purpose, tariffs can be a very, very, very good tool in the toolbox from an economic perspective. I just got to ask you a question. What are we targeting with Canada?
Yeah, listen,
I get China, and even to a certain extent, I do disagree with the tariffs on Mexico, but I do understand them, right? We have a fentanyl problem. We have a southern border problem. The stay in Mexico policy is certainly going to help those. The military presence on the southern border is certainly going to help those. And so tariffs are just, even more on top of that. So I do have some open questions on, the impact on that. But our friends to the north, what are we getting at it? What are we targeting there? Our number one import from there is oil, Mark.
Yeah, listen, Wall Street Journal, I think, had a line in their article today that sums it up. If Trump likes tariffs for tariff's sake, right? Because they said it appears Trump does not have a strategic purpose here, that he likes tariffs for tariff's sakes. If that becomes...
He has said he loves tariffs 19,000 times.
Yeah. If that becomes the market conventional wisdom, that is going to act as a severe weight on the market.
If general broad-based tariffs for isolationist purposes becomes the economic policy of the United States, you're 20 to 30% overpriced here.
Listen, globalism is market friendly. Isolationism is not. That's the economic and market impact here.
That's the story of the world for 6,000 years too.
Yeah, this is not a political or a complicated matter to discuss. This is just 2 + 2 = 4 here. Now it's the market
matter to discuss because political opinions on this, but again, I'm not having a political conversation.
Yeah.
This is an economic conversation.
I know, for me, it's a thematic conversation.
This is a market conversation. And from a market perspective, and again, I think we got to be a little bit patient in allowing to work out some of the details here. Because we have seen in recent history, Trump is extremely quick to move right now. And I don't think that's a negative. We want to see movement here. So Trump is extremely quick to move here. And in doing so, he's probably moved too fast on a couple things. And over the next 24 hours, they kind of clean that up. For example, last week when they did the federal freeze, right? for about 3, 4, 5 hours, everybody was in chaos. Everybody was like, well, what about this? What about this? Are we going to shut down this? And is Medicaid going to die? Is Medicare going to, like, there was all this. And then, it got cleared up, and it's like, okay, now we kind of have an understanding of what's transpiring there. And so I do want to stop short of directly criticizing the announcement, because again, how they are utilized is going to be equally as important as that announcement itself.
Now, I will criticize directly the announcement 2 hours before the market closed, because that,
that's rookie moves. Like that's Google reporting.
And I love what you said. That is not what the first Trump administration would have done. They would not have done that.
Cut low. Baghdad Bob would not have allowed that.
They would not have allowed that.
Have allowed that.
So
the first Trump administration, specifically in the first couple of years, they cheerleaded the market.
And that is one of the simple bullish themes that is out there. That is another thing. Like, if the market gets a sense that this is not a cheerleading market administration, it is very important for them to get this one right, because the market and the economy tied to one-on-one. They want a growth agenda. If you have a market that slides 4, 6, 7, 8, 10% in the first half of the year because of the weight of a lot of things, that is going to have a direct impact on the economy. Now, if you traded in 2018 or 2019, which you did, which I did, and you traded during these trade wars, get used to a lot of positive and negative headlines.
That's true.
Because all of a sudden Monday morning markets can be down 1%. And Baghdad Bob, Larry Kudlow, was fantastic at this in 2018, 2019. Come out and be like, here's some BS. And markets would celebrate and buy it up. It is so headline sensitive, because all you need is the smallest headline to cause a rally in these environments. That we're thinking about.
Chuck, you're talking about algos back in 18 and 19. Hey, I'm sorry, it's on steroids.
They're so much more sophisticated these days.
There's so much more sophistication, but there's so much more money in the market.
So the tariff things, like, while you might hear concern in Matt or my voice, it's not a tactical bearish thing. It is this is just another layer of complexity into this thing until clarity is provided. But I will say this, Matt, if the clarity provided is no tariffs for tariff's sake, markets aren't going to like that. Markets go lower. Well, if that is the clarity that is provided.
I agree with you. If it's broad-based tariffs from a economic philosophical perspective, that you just believe in broad-based tariffs because you think it's going to shore up U.S. debt, U.S. financial viability, whatever the case is, the markets will hate that. They will hate broad-based tariffs.
They won't like that.
The market has loved free trade agreements for 50 years. Like, we're not talking a short time period here. And again, I just want to stop short here of saying, okay, are they really going to do 25% broad-based tariffs on Canada and Mexico? Mark, the free trade agreement between Mexico, U.S. and China, U.S., Mexico, and Canada was negotiated by Trump in the first term. When they ripped up NAFTA and renegotiated NAFTA for NAFTA 2.0. I forget what they called the trade agreement off the top of my head, but it was a NAFTA 2.0. So once again, is there going to be secondary announcements early in the week? This is what the tariff really is. This is what the tariff really is, where they come out and kind of, clean up some of that, the announcement on Friday. And so I do think we need to hear a little bit more of the context for specifically what these tariffs are. I also, quite frankly, need to know what we're even trying to accomplish with tariffs with Canada specifically. I honestly, I've been thinking about this for 24 hours now, Mark. I don't know what we're targeting from Canada.
And that's why the tariffs for tariff's sakes, right? Like, if it's tariffs for tariff's sake, and once again, there's a lot of layers to this. The market's not going to like that. They're not.
Well, of course, the market hated it on Friday. The market was getting in a mode of breaking out, a little like just hesitation in front of that 610 breakout level tariff announcement, and it was a selling program ever since then. You kind of tried to stabilize right before the market closes, but the right after the market closed, it continued to sell down. So obviously the market the market got a little bit of a grenade on Friday with the tariff announcement. I think we're going to need to see exactly what the detail out of that tariff announcement is. But as of right now, that is a concerning data point. I'll just say this as we kind of conclude the skyline here, Mark. The levels of this week, I think the most important thing that really got determined this week for me, and I've really appreciated the conversation, and I've enjoyed the conversation. Sometimes we get into the political conversation because it's very important from an economic perspective, and that's where our focus is obviously on the market side of the equation and the economic side of the equation. So appreciate your thoughts there, Chucky. But again, I think the most important thing for me this week that got solidified was the technical conversation. You have an increase in support at this point. We did not have that last week. You have an increase in support to 595. And on Friday, even with the volatility candle, you were seeing that 610 level acting as a resistance even before we saw the tariff announcement. The market was starting to hesitate at that 610 level. That is now a rock solid resistance.
Oh, it is a very important level.
And so now the levels, and having an understanding of the levels is as important as having an understanding of what is driving the current market. 610 resistance, 595 support. Those are the levels, and I really do think you got to treat this like a little bit of a K-trade situation, where if you see a confirmation close above 610, that's going to be an indication of a multiple time frame breakout. You got to get prepared for that. Earnings landscape has been extremely positive in my estimation. On the flip side, a violation of 595 could see a volatility pocket, and with volatility these days, could be a quick journey to 580.
Yeah, no, and that's the thing, the fast moving, and that's the thing. Like, listen, you have one positive trade war headline, and you got Waller on Thursday selling something, and maybe the inflationary data and the unemployment report on Friday.
Mark, if on Monday morning they cleaned up the tariff language with non-broad-based tariffs, but give us
yeah,
a
like
bit of
it
detail,
does not take much
headline,
for you to be talking a breakout.
The market can focus solely on the earnings landscape. That's the theme that drives the market to the breakout. If you get an alleviation on the tariff concern, we're not going to be talking about the Fed until a while now. They punted. We're going to punt on them. Next week, though, the number one thing that is half glass full about this marketplace, because there is some macro concern right now, is earnings. Earnings has been a net
It's
positive.
a stabilizer.
And some, it is that net stabilizer. There's no doubt about that. Blended growth is north of 13% right now. We're tracking the best earnings season since the fourth quarter of 21. And that was coming out of the economy being closed. So earnings has been a positive landscape in general. The veracity of the beat has been a little bit more than in recent quarters, although slightly less than the 5 and the 10-year average. EPS beats is at 77%. The only thing I would say earnings has been missing is they've kind of lacked that thematic growth spark that you oftentimes do get in the heart of earnings season from companies like Microsoft or Apple or Meta. And it just hasn't had that one company that stood out. Like in the important stocks out there in the market, Taiwan Semiconductor had a very good report. Meta had a very good report, but they weren't like, oh my goodness, you gotta focus on this stock. This is going to drive the entire marketplace. There hasn't been that unifier from an earnings report that just sparked the entire marketplace. It's been good, but it hasn't been that growth analysis coming out of the market. I like how you put it. Earnings has been that stabilizer. My open question is, can Amazon, can Google, the two bigger reports this week, or secondarily, do you see an AMD light the world on fire? Do you see an Eli Lilly come out this week in healthcare, do something special? And so, next big dogs on deck, Eli Lilly, Google, and Amazon. We'll see if they can provide something.
And that is one of the questions. Going to finish off with a couple quick questions. One of the questions from a student was, Matt, what is the most important earnings report?
Are you done with tariffs? Like,
I'm done. The only thing I would say from a macro perspective.
And give me an official transition into.
Okay. Well, I mean, I thought there was a transition there. Give me my summer thought on this week. The Fed's the most important for me. It always will be, bar none. Like I did not like what I saw there. I didn't like this was the most concern I've came out of a
Yeah,
week in a long time.
it was.
Like
Me too.
it was the multiple levels of barrage. It was like, oh, AI, US tech dominance, kind of threatened. The Fed not delivering a Waller type message. Oh my goodness, we got to deal with tariffs again, a la 2019, right? Like, and so it was the cumulative effect of multiple negative storylines on the macro side.
Sometimes you got to get punched in the face to figure out who you are. The market, it got punched in the face this week with the DeepSeek news, with the Fed punt, and with the tariff announcement. Now let's see what happens here, because sometimes you get punched in the face, you go down. Sometimes you just double down and get the job done. We'll see. But I'm right there with you. I thought this was a negative macro week.
We'll see. We'll see how it plays out. Yeah, I'm curious. My question to you: does the White House clean up the tariff communication in the coming days?
This isn't one you can just be broad based on your language. It's very important, and obviously you can't just I don't think they want to just do broad based tariffs. So I think they have to clean it up. If they don't, I think the market's going to force them to clean it up. So
just sloppy rollout,
one way or the other. And again, can we just we're going to call spade a spade here. If Janet Yellen would have dropped that news 2 hours before the market,
it's because she wanted the market to go down.
Purpose for it.
There was purpose.
Yes, there was a purpose for that. I don't understand what the purpose was here on the Friday dump. This is a negative news story to the market. It was obviously going to be a negative news story for the market, and you dumped it 2 hours before a weekend when the market was getting blasted all week by news stories. This was a news story that got dumped without thought about how the market was going to react. And the market, they're not going to play second fiddle long to anybody. They'll force that conversation. So
they always do.
My answer to that question would be, I do think the Trump administration, after they see the reaction, and specifically after they see that Wall Street Journal headline, they are not going to like that Wall Street Journal headline, and rightly so. I think they are going to.
And it's not as simple as saying, "Oh, well, they
listen." If the New York Times would have said that headline,
nobody would have cared.
Nobody would have cared about it. You and I would not be talking about it right now.
Wouldn't have mentioned it.
But the Wall Street Journal's different.
In fact, it is the only paper that could have that headline that would spur a serious conversation. Because it's a market conversation.
I think so. If CNBC runs that headline,
nobody cares.
Makes fun of it, quite frankly. Wall Street Journal does. It's like, all right, that's.
If Goldman Sachs had analysis,
the Wall Street Journal runs that headline to get Trump's attention. That's what I think.
Why? Yes, and the words were chosen carefully.
I don't know if they're going to like the attention they get, but yes, I do think the Trump administration and President Trump himself will try to clean up this tariff announcement, because that was a sloppy way to announce it.
Yeah.
And I'm sorry, say what you will about the first Trump administration. They weren't sloppy when it came to announcements with the market.
Dude, Baghdad, Larry Kudlow, who did most of the communication, we called him Baghdad Bob, because if you don't know the reference, Baghdad Bob was the media correspondent for the Iraqi government during the second Gulf War, where American troops were invading, and he would come out and say, everything's awesome.
What are you talking about? There's nothing
total control. Here. Like he would lie
there
with his smirk on his face. He would lie about what was going on, even though Iraq was imploding and America was safe. Yeah. And he would come out with a straight face, kind of a little smirk, and be like, "That's all good."
We could have got the worst economic report ever, and there's old Larry Kudlow coming out.
It would be like, "This is great."
Giving an interview about. No, you don't understand why this negative report is actually positive. But
he was a fantastic cheerleader for the first Trump administration. Fantastic. This Trump administration needs a Baghdad Bob.
They'll get there.
They need one.
The market will force it. But yeah, I do believe I think they have to clarify this language out of the tariffs. Like,
I hope so. Like, because that's the thing is, like, whatever it is, man, there's a lot of unknowns.
And we'll move on. Listen, once the market was used to the trade war, then it just became part of the equation. Once the market was used to the pandemic, it became part of the equation. Once the market was used to Russia invading Ukraine, it became part of the equation. The market will get used to the situation, and it will move on. But in times of uncertainty, listen, the market might act like it hates negative news. It doesn't. It just
It
prices
hates
it.
uncertainty.
The market hates uncertainty, and there is some uncertainty with this tariff announcement. And so, yeah, I do think it's needed to clean it up.
All right. Now, just a couple student questions. Finish up our podcast. Student asked Matt, "What is the most important earnings report in the coming week?"
Oh, let's take a look at the landscape very
And, I
quick.
mean, we haven't even had time to look at the week ahead because
Yeah, let's
this
look at
was
the
8
landscape.
podcasts in one this week.
Yeah, like we wanted to tell the narrative of the week because there was so much this week. There was just so much this week. When you're looking at the landscape, obviously there's 132 S&P 500 companies reporting earnings this week. Obviously, that is just a tremendous amount of stocks that is reporting earnings this week. When I look at it just from like a top-down perspective, kind of looking at the market, I think you got to say Amazon, Google, and Eli Lilly would be the leaders of the bunch. But there's some really important companies as well reporting earnings this week. I'll give you my number one per day. How's that, Mark?
Yep.
On Monday, I have to say Palantir will be the most important company reporting on Monday. I don't feel like there's a close second on Monday. Palantir is a tier 2 AI name. They're a very important growth stock to the AI equation. They've been going through a little shifting volatility. So I have to say Palantir on Monday. On Tuesday, you got to say Google on Tuesday, no doubt about that. But AMD is a extremely close and maybe even more important company when you're talking about the DeepSeek information that came out over the weekend. And so I will say Google because Google will help us on the CapEx side of the equation. AMD is a little bit more niche. So I'll say Google on Tuesday, but AMD's a close one there as well. On Wednesday, ARM. You got to be thinking ARM on Wednesday. Disney's going to get some headlines, no doubt about that. Boston Science from an AI robotics perspective, yes. But ARM and Qualcomm, the combination of those two is going to be really important. So Uber, Walt Disney, Qualcomm, ARM, all very important. I'd say Ford, but Ford's taking a backseat to GM these days. But most important, again, it's with all the information from this previous week. I'm going to lean on technology on the most important reports this week. I think ARM is going to be a fascinating report coming out on Wednesday, but don't sneak on Qualcomm. They're pretty important as well. Thursday, you got two big dogs there. You got Amazon, you got Eli Lilly. I have to say Amazon's the most important one. Secondarily, keep an eye on Elf Beauty coming in from below. We'll talk about them on Thursday. And then on Friday, you don't get a lot of important ones on Friday. So I'm not even going to say there's an important one that is actually happening on Friday. Most important this week, I'm going to go with Amazon. I'm going to go with Amazon.
Friday won't be boring. 8 minutes before the market closes, we'll announce we're invading Greenland. So
I doubt that.
Coming on Friday.
But, yeah. What about you? What's your
listen? I have not even had a chance. I'm glad this question was in my queue from a student because I had not even. This was a process. All of these macro things. I have not even had a chance to plan the week ahead. But those ARM, AMD, like. Mm-hmm. Those stand out to me, right?
But maybe it's a big AI week from Palantir on Monday, Google and AMD on Tuesday to Qualcomm and ARM.
No, Palantir for the first time ever is an important market report to me because it's the price action that follows. Mm-hmm. Do you see one of these names like Palantir, who's had great runs, like fantastic runs? Do you see negative price action, or do you see, just normal response from earnings, right? Or do you see positive? IBM, I mean, who knew IBM was going to be the gap and goer, right? But Palantir, sneaky report, but a lot of, Amazon probably, like, discretionary has been trading on its own for a while. I don't think Amazon will be a market thing. Google always can be, but it's those ARM, AMD, Palantir, those names stand out a lot to me this week.
All three of those tier 2 AI gold rush names too.
Yeah. So, all right. Portfolio question. What is the absolute most you would own of any one asset? And I think what they're referring to is, where do you cap out in a given area, right? Where do you cap out in a given area? I'm very, very conservative. I usually, like, on any given area, like 20% is kind of my cap for me, right? And it doesn't mean I'm in 20%. For example, gold. Am I willing to own up to 20% of my portfolio in gold? I am. Am I willing to own up to 20% in Bitcoin? I am. That's far above the 2%, by the way. That does not mean
2% is a trading role. You're talking
yeah,
investment.
yeah. But no, I think I saw some like financial firms be like, it's okay to have 2% of your portfolio in Bitcoin. I'm like, I think they're speaking to people.
Yeah, you must be speaking to the traditional mutual fund.
That's who that's what I was. That's the kind of snide thing. Now, that does not mean I have that much at any given time. In fact, very rarely do I have that much at
I
any
think
given
a
time.
lot of Wall Street people are now recommending upwards of 20% of disruptive asset classes such as Bitcoin.
You know, but I do believe that you should have caps and a way how you manage the
I think on
fluctuation.
any one asset class, I think I like the 20% max cap, because that's kind of where you and I both look at, like, gold. Gold is our number one most confident asset class, and I think the reasons are fairly similar for both you and I. All macro, macro, macro. It's why you have so much confidence in gold. Macro meaning, like, they're going to go into more debt explosions, more debt explosions, more money, print more money, print more money, print more money. So I like the 20% max rule there on gold. That doesn't mean you're putting 20% specifically in gold itself. You might have some allocated in gold, you might have some allocated in the gold miners, but you're kind of targeting that asset class. I think you can say the same thing for Bitcoin as well. On an individual stock, I think it's a little bit less than that, quite frankly.
Not even close. Like,
Yeah,
I get spooked when I get 6-7% on an
and
individual.
I think, like, long term, depending on allocation, you can, like, 10%, but once you get above 10%,
Well, you better really believe it if you
well,
like.
what you typically start doing is you typically start being forced to take some off the table,
Yeah,
because all of a sudden, if it's growing, all of a sudden it's 11%, 12%, 13%, 14%. And so I think 10% is like max top shelf on individual plays on a long-term investment. I think about people like Warren Buffett. If you're designing a portfolio, like, I think you would rather have more, not less investments. I think you would want to have, 10, 11, 12, 15, 20 different investments. And obviously, but Warren Buffett will also put 40% of his portfolio in Apple for a given couple of years. But I like the 10%. If you ever get above 10%, I think you're probably being a little too aggressive on that, and you don't have other beautiful things in that portfolio.
I'm going to pull this last one from a Discord question that came up towards the end of the week in our Discord channel. One of the things we do for board members is have active conversations. It was on Chewy. Basically, the individual asked, would you go for a covered call on Chewy? Now, the answer I gave them was, I don't like a covered call here because on the weekly chart, and I'll do this, I'm at a resistance level. I love the cash flow elements of this chart. I think it's a fantastic cash flow. I just like the naked put versus the covered call in this circumstance, where you're coming up against a resistance level that I respect. And so coming up against a resistance level that I like, well, it's great cash flow pattern. It's been a clear trend coming off a great reversal. The trend's been very consistent. So it screams like a good cash flow environment. But it's like, wait for that breakout to occur. But I'm not down with it today. I like the naked put side of that equation. What are your thoughts?
If you're thinking about a strategic covered call versus a naked put, I think the naked put is a much better situation here. I agree with you. If you're already investing in Chewy, you're making a decision whether or not to sell a covered call, you would absolutely sell a covered call.
Yeah, this was a not yet invested in question.
Yeah, if it's not, no, you would probably prefer doing boomerang to use the naked put to get in at a cheaper price instead of trying to chase the covered call up around 40. Also, the reason I say that is equally in the back of my mind is you're thinking Chewy above 40 on the trader side of the equation. This is a multiple time frame breakout, mid-tier breakout, beautiful resistance zone, easy decision above 40 here to take action. And so I think you wouldn't want a covered call situation if you're thinking, I'm buying that breakout. You know what I mean? You would much rather.
Yeah, the irony with this chart, it's either a naked put today or a directional play
Or it's
above.
either a naked put or we're buying calls above 40. Like that's.
Yeah, the covered call actually doesn't quite fit on this chart because
Now,
other strategies are better.
Again, if you were investing,
unless you're already in.
and you were already involved and you were already doing things like that, this is a level where I would want to cover, not 40. I would cover above 40. I might even cover straight at 40, quite frankly, because if you do break out of 40.09, I think you got to be thinking directional there. Chewy sneakily is one of the better multiple time frame.
I thought it was an interesting chart to have a discussion on the question on, because I think it brings up several principles on how traders look at a chart, right? It's like Matt's eyes as a direction. It's like you break out of there, that's directional. But his cash flow eyes says, oh, I should smash a at the money call today and wait for the breakout to occur. I look at it's a trader's chart that I think
it is a trader's chart. It's a good question on Chewy though.
Yeah. All right. Listen, bro, it's been a big week. I hope next week's not as big. I really don't. This one was a long week for me. But it was an interesting one. Send us out, bro.
Yeah, if you love the podcast, guys, definitely give us a like and share on whatever platform you are watching the podcast. And if you're listening, thank you so much for being the best part of the trading justice community. And that being the listener, we are here for you. If you need anything from us, you can always hit us up at team@tackletrading.com. You can hit us up in our Tackle Trading Discord. You can join by hitting the link in the description below. Yes, we do have a lot of channels for our pros that we have conversations in, but we have a new traders channel as well for everybody in our Tackle Trading Discord. So in the description below, you can hit the live events link and see kind of what webinars we have planned for February. You can hit the Discord link, and you can always sign up for a free trial membership of the Tackle Trading Pro community and get everything that you need from a trader's perspective that needs education plus application. We'd like to put them both into there. And with that said, I hope everybody has a wonderful, wonderful week. And if you need anything from us, you know how to get a hold of us.
Have a great week, everyone.